Welcome to INO FOREX. You are watching INO FOREX. Stop scrolling if you are a beginner in forex trading. This video could save you from making common mistakes. Today, I'm going to break down forex trading in a simple way with no complicated things. In this video, I will take you step by step through the basics so you can build a strong foundation. By the end of this video, you will understand what forex trading is, how the market works, and the key skills every beginner needs before pressing a trade. So stay with me until the end, and if you are new to this channel, make sure you have subscribed to this channel so that you will never miss our next videos. So I'm going to start by showing you the three main movement of the market. So watch this video carefully. It's simple. So market moves in three main ways. I'm going to show you. First way, market moves in uptrend. When the market is moving in uptrend, we say market is bullish. When the market is bullish, this is when the price is consistently moving high, creating high highs and higher low. I'm going to show you an example. For example, as you see on this chart, market moving in uptrend, or this market is bullish, is creating higher high and higher low, higher highs and higher low. When the market is bullish, creating higher high and higher low. The trending idea, when market is bullish, we're looking for buy. We are looking for buy opportunities. Because when market is bullish, the buyer are in control. So that's why we are looking for buy. When the market is bullish, this moves called impulsive move. And when market create a pullback, this moves called corrective move. So this is impulsive move and corrective move. Impulsive move and corrective move. So when do we buy? Because market is bullish, we are waiting market to create a corrective move. When market creating a corrective move, that's when we can take the trade, because we're expecting that market will again push to the upside. So this is the first move of the market. We're going to the second move. The second move of the market called bearish market, or market moving in a downtrend. When the market moving in downtrend, this is when the price is consistently moving low, creating lower highs and lower lows. Let me show you an example. Okay, this is how bearish market looks. When the market is bearish, it creates lower lows and lower highs. This is lower highs and this is lower lows. This is lower highs and this is lower lows. Lower highs and lower lows. When the market is bearish, it means the sellers are in control. When the market is bearish, the trading idea you need to have, we are looking for sell opportunity, or we are looking for short. When the market is bearish, we sell, because as I told you, the sellers are in control. So when the market is bearish, this move called impulsive move. When the market make a pullback, this move called corrective move. This is passive move, corrective move, impulsive move, corrective move, impulsive move, corrective move. When do we take the trade? When the market is bearish, we take the trade we take the trade after corrective move. When the market create impulsive move and create a corrective move, after corrective move is when we will take the trade. So never try to buy when the market is bearish. As I told you, we're looking at sell opportunities. So this is the second movement of the market. I'm going to show you the last movement of the market. So the third movement of the market, called ranging market, is when the market moves in sideways. This is when the price moves between support and resistance without a clear trend. Let me show you. So this is how sideways market looks like. So here we have a resistance and here we have a support. So when the market moves in sideways, it moves between resistance and support. So when the market moving in sideways, you don't need to take the trade, because mostly those trade has low probability. So the trading idea you need to have is, you need to wait market to create a clear market structure. Better to wait to see the direction of the market, whether the market will move in up trade or in down trade. When the market is ranging, no need to take the trade. So I think now you are understanding those three main movements of the market. The one thing you need to keep in mind is that you need to trade when the market is up trade or market when is down trade. When the market is ranging, you don't need to take the trade. So the second thing I need to share with you is in the market how you can identify the valid corrective move. As I tell you, when market is uptrend, is making impulsive move and corrective move, impulsive move and corrective move. And I told you that when market is in uptrend, we need to take the trade when market makes a corrective move. Because after corrective move, we expect that market will mitigate something here and shift it to bullish. So many traders doesn't understand how to identify the valid corrective move. That's what I'm going to share with you. So here market is bullish. This is impulsive move and this is corrective move. The important thing I need to share with you, I told you that when market is bullish, we're looking for long or for buying opportunity. So the important thing I want to share with you is that we don't need to buy to every corrective move. Every corrective move doesn't have a high probability. Which a valid corrective move which can make us to take the trade. That's what I'm going to share with you. So the valid corrective move is corrective move which has taken a liquidity. Because in the market, when market make a corrective move, the main things made a corrective move is a liquidity. Mostly when the market makes a corrective move, it wants to take a liquidity. So, for example, this corrective move didn't take any liquidity. That means this corrective move doesn't have a high probability. We don't need to buy from here, because when you buy from here, you are buying in liquidity zone. Here market can create another corrective move to find the liquidities and it can hit your stop loss. So I'm going to show you the valid corrective move. So look at this diagram. You see, this market is bullish. This is higher high, this is higher low. This is passive move, this is corrective move. This is passive move and this is corrective move. But the difference is this one. This corrective move didn't take any liquidity, but this one, as you see, it took this low. So as I told you, this low becomes a valid corrective move because it took a liquidity. So between this corrective move and this corrective move, which one has high probability to push the market? According to what I told you, as you see, this one which took a liquidity is the one which has a high probability to push the market. Because the main purpose of corrective move is liquidity hunting. When the market creates a pullback, mostly it's looking for the liquidity, for taking the previous low. When you take the trade before market takes the liquidity, mostly you become a liquidity. As I told you on the previous video, when market takes inducement, we mark a higher high. This become a higher high. And when the market breaks a higher high, we confirm a break of structure. It's the same as when the market is bearish. It's the same as when the market is bearish. As you see, this is impulsive move and corrective move, and impulsive move and corrective move, and impulsive move. As I told you, when the market is bearish, we're looking for short or we're looking for sell. Because when the market is bearish, the seller are the one who are in control of the market. We don't need to buy when the market is bearish. So when do we sell? We sell after a corrective move. We are waiting the market to do a corrective move, and then when you see a confirmation, we take the trade. So this is corrective move. As I told you, a high probability corrective move is a corrective move which took a liquidity. So this pullback market created a corrective move, but this pullback didn't take any liquidity. So if you are selling from here, you are selling before market grabbing a liquidity. So this setup has a low probability. Here again, market create another corrective move, and this corrective move took the previous high. This is inducement. So when you sell from here, this setup has a high probability because this corrective move takes the previous high. So I think you are understanding. So I'm going to take one trade as an example to help you to understand more. In this example, I'm going to show you how you can use all those things you have seen to take a good trade. So I'm going to show you how you can identify the valid corrective move on the chart. So stay with me and take this trade together. It's very simple. Let's go. As I told you, first of all, we start by mapping market structure. To mark a market structure help you to identify the direction of the market. So as you see, based on what we have seen on the last chart, when the market creates higher lows and the higher highs, means the market is bearish. So as you see, this market is bearish because it creates lower high, lower low, lower high, lower low. So as you see, market push down and this is a pullback, but this pullback didn't take any liquidity. So you don't need to sell from here because as you see, our inducement is this one. Market made a pullback and didn't take this high. That's why you don't need to sell from here. Market didn't take any liquidity. Market breaks this low and market continues to push to the downside. Here market create a pullback and then push to the downside. When you're going to mark inducement, you mark the recent high. You mark the recent pullback from the lowest point. From here to the upside, our recent pullback is this one. As you see here, market, this is inducement. And then as you see here, market create a pullback and takes this inducement. That's mean on this point, this corrective move takes liquidity. So if market takes liquidity, when you sell to this point, this setup has a high probability. When you see a confirmation, we can sell. In the next video, I will teach you which confirmation or confluence you can follow to take a good trade. This is our inducement. Market takes inducement. When market takes inducement, we mark a lower low. This is a lower low. So then market breaks this low, but as you see, market not cross below this low. So we will confirm a break of structure when market cross below the lower low. Market again takes this high. This high becomes a liquidity. Okay, as I told you, inducement is the recent high. So because from here, this high is only recent high we have, that's why this high becomes a liquidity. So we mark this high as inducement, and this low becomes our new lower low. So if market breaks this low and cross below, we'll confirm a break of structure. So this is our low, our lower low, and this is inducement. So as you see, market breaks the lower low, but candle not cross below the low. Candle only sweep the lower low. We confirm the break of structure when the market cross below this low. Okay, finally market cross below this lower low. So this is a break of structure, boss. As I told you, this is impulsive move and this is corrective move. Again, impulsive move and this is corrective move. So as you see, this pullback takes the previous high. So it takes the liquidity. So after liquidity, that's when we will take the trade. As you see, here market made a pullback and market takes this inducement and the market mitigate this order flow. Here we have an mitigated order flow. That's why the seller pushed the market to the downside. In the next video, I will teach you step by step how we can take the trade, which confluence you can see and take the trade. This is a break of structure. After break of structure, we are going to mark an inducement. So this is inducement. If market takes this inducement, we are planning to sell. As you see, here market takes this inducement. As you see, this is corrective move, and this corrective move is internal structure. So this internal structure is bullish. It creates higher highs, higher lows, higher highs and higher lows. As you see, market sweep inducement, and when the market sweep inducement and break a recent low, we confirm a choke. We confirm that market shifted to bearish. I will teach you more about this type of choke in the next video. So don't be confused. If market sweep a previous high and break a recent low, that is a choke. I will teach you more about this choke in the next video. So after choke, we plan to sell. So now we are going to sell. I'm going to show you all confluence. So after market sweep inducement, market breaks this low. So this is a change of character. In the next video, I will teach you everything you don't understand. This is just an example to show you how you can take a trade after market takes inducement or liquidity. So because of the market already takes liquidity, market sweep inducement, we are going to take a trade from this order block. We place our order to this order block and we set our stop loss above this high. And TP, we set our TP to the lower low. This is our next lower low. So as you see, our market hit a take profit. So I hope you understand. We have seen how market moves. If you are not understand, can you watch this video? It will help you to understanding better. So I'm going to end our video. So thank you for being with us. If you forget to subscribe, make sure to subscribe so that you will never miss our next videos. So I think this video will help you to increase your win rate. So I wish you a good luck. See you to the next video.